For decades, silver was treated as an afterthought in the global financial system. It was seen as a secondary metal, a volatile cousin of gold, something industrial users needed and investors occasionally speculated on, but never something governments publicly worried about. Gold was strategic, oil was strategic, semiconductors were strategic. Silver, at least officially, was not, until now. Quietly, without headlines or press conferences, the United States government has begun treating silver not as a commodity, but as a national security asset. This shift did not happen overnight, and it did not begin with a single announcement. Instead, it emerged through policy language, defense procurement priorities, supply chain assessments, and strategic vulnerability reports that most people never read. But when you connect the dots, the message becomes impossible to ignore. Silver is no longer just money. Silver is no longer just an industrial input. Silver has become a strategic bottleneck. And when a material becomes a bottleneck for national security, history shows only one outcome. Governments intervene, markets distort, and prices stop behaving normally. To understand why silver has crossed this line, you have to understand how modern power actually works. Not the kind discussed on television, but the kind embedded inside energy grids, weapon systems, data centers, satellites, and military supply chains. Modern power is electrical. Modern power is digital. Modern power is conductive. And silver sits at the center of all three. Silver is the most electrically conductive metal on Earth. It has no substitute that performs at the same level, at the same scale, across the same number of critical applications. Every advanced military system relies on it. Every secure communications platform uses it. Every modern energy infrastructure upgrade depends on it. Yet, unlike oil, unlike rare earths, unlike uranium, silver is not stockpiled at scale by governments. In fact, most governments have no meaningful strategic silver reserves at all. The United States once did. But it sold them. And now that decision is coming back with consequences. Over the past 2 decades, the U.S. government steadily liquidated its silver stockpiles under the assumption that markets would always supply what was needed. This was the era of globalization, just-in-time inventory, and financial optimization. Strategic redundancy was seen as inefficient. Supply chains were stretched across continents. Resilience was sacrificed for cost savings. It worked until it didn't. The problem with silver is not demand. Demand has always existed. The problem is concentrated demand growth colliding with constrained supply in a world that can no longer rely on stable geopolitics or frictionless trade. Defense systems today require far more silver per unit than they did 20 years ago. Precision weapons, radar systems, encrypted communications, electronic warfare platforms, and space-based assets, all silver is being pulled in too many directions at once. And unlike other strategic materials, silver is rarely mined on its own. Most silver production is a byproduct of mining for copper, lead, zinc, or gold. That means silver supply does not respond quickly to price increases. You cannot simply turn on more silver production when demand spikes. This structural rigidity is what alarms governments. When the U.S. Department of Defense began conducting updated supply chain vulnerability assessments after 2020, silver repeatedly appeared as a high-risk material. Not because it was rare, but because access to it was no longer guaranteed under stress conditions. Supply chains that look stable in peacetime behave very differently under sanctions, conflict, or financial disruption. The freezing of Russian reserves in 2022 was a watershed moment. It demonstrated that financial systems could be weaponized, and more importantly, the physical supply chains could become unreliable overnight. For policymakers, the lesson was clear. Dependence is risk. Silver dependency is especially dangerous because it is invisible to the public. There is no silver cartel. There is no OPEC-style buffer. There is no strategic petroleum reserve equivalent for silver. If something breaks, there's no release valve. This is why policy language has changed. In recent years, silver has begun appearing in the same documents as critical minerals, defense materials, and strategic supply chains. Not always by name in headlines, but clearly embedded in classifications related to electrical components, defense electronics, and energy infrastructure. This is deliberate. Governments do not want to alert markets prematurely, because the moment a metal is openly labeled strategic, behavior changes. Hoarding begins, export restrictions follow, prices decouple from fundamentals, volatility explodes. So instead, the approach is quiet recognition and silent preparation. But preparation itself leaves footprints. One of the most important signals is procurement behavior. U.S. defense contractors have increased long-term sourcing agreements for silver-containing components, locking in supply rather than relying on spot markets. This is not normal behavior in a supposedly liquid commodity. It signals concern about future availability, not just price. Another signal is recycling policy. Silver recycling from electronics has suddenly become a strategic priority, not just an environmental one. When governments encourage recycling of a material that was previously ignored, It's because they know primary supply cannot keep up. Then there's the issue of stockpiles. Unlike gold, silver stockpiles are fragmented, private, and largely unreported. This makes them difficult to mobilize in a crisis. The U.S. government understands this vulnerability. You cannot requisition what you cannot locate, audit, or legally control. This is where national security thinking enters the picture. When a material becomes essential to defense readiness, governments do not leave it entirely to market forces. They shape access indirectly, through regulation, incentives, and strategic partnerships. And this is already happening. The U.S. has begun prioritizing domestic and allied supply chains for silver-related components, reducing exposure to geopolitical rivals. This is not about silver jewelry or retail investment. It is about systems reliability. If a satellite fails because a component cannot be replaced, that is not an economic issue. It is a security failure. If weapon systems are delayed due to material shortages, that is not inflation. It is vulnerability. And silver sits quietly inside these systems, unnoticed by the public, but impossible to replace by engineers. What makes this situation even more unstable is the disconnect between paper silver markets and physical silver reality. On paper, silver appears abundant. Futures contracts trade in volumes that dwarf actual production. Price discovery occurs in financial markets, not physical ones. This has created a false sense of security. But governments do not plan based on paper liquidity. They plan based on physical access. And physical silver is much tighter than prices suggest. This divergence is dangerous because when physical availability becomes critical, paper contracts do not deliver security. They deliver volatility. History shows this pattern clearly. Whenever a commodity crosses from economic to strategic, markets lose control. Pricing becomes political. Access becomes conditional. And those who assume liquidity discover illiquidity overnight. The U.S. government understands this dynamic well. It has seen it with oil, with uranium, with rare earth elements. Silver is simply the next metal to cross that threshold. The difference is that silver's role is far more embedded and less visible. You cannot simply replace silver in a missile guidance system with copper. You cannot redesign global electronics overnight. You cannot pause energy transitions without political cost. This means silver demand is inelastic. It does not respond to price. It responds to necessity. And necessity always overrides markets. This is why the labeling of silver as a national security issue, whether explicit or implicit, is such a critical shift. It marks the moment when the rules begin to change. From this point forward, silver will no longer behave like a normal commodity. It will behave like a strategic asset. That means tighter supply, less transparency, more volatility, and sudden repricing events that catch the public by surprise. This is not a prediction. It is a structural reality. Markets can ignore this for a while. Prices can remain suppressed. Headlines can stay silent. But systems do not lie forever. When stress appears, when inventories are tested, when delivery matters more than contracts, the repricing will be violent. Because silver does not move gradually. It moves when something breaks. And the U.S. government knows this. That is why silver is no longer just metal. It is infrastructure. It is defense. It is security. And once a material enters that category, it never goes back. For deeper data-driven macro analysis like this, like the video and subscribe to the channel.